Morgan Stanley shares have fallen nearly 25% from their 52-week high back in March, but Wells Fargo banking analyst Mike Mayo says now is the time to buy the stock. He upgrades it to an outperform. $60 is the price target. We've made it our call of the day. Mr. Mayo joins us here on set. No prop. We only bring props for JP Morgan. Is that the deal?
Well, I would have, but I did not get the memo. You're supposed to say, what memo? Work with me here.
What memo?
No, the memo that said...
The joke already started off badly. You know what we're going to do? We're going to get right to it. Why Morgan Stanley?
Well, look,
because now the joke fell flat.
No, well, the memo that says the cycle is over. For the large banks, the cycle's not over when problem loans are down 10% year over year and down 5% linked quarter. When you see that the resiliency of the banks is stronger than it's almost ever been. You have the best earning stability in 1 or 2 decades. So the cycle's not over when that happens. And the concern we hear is that, oh, peak earnings this, peak earnings that. It's not peak earnings for the largest banks. We'll hold up our earnings models against anyone else's earnings models. So that certainly applies to Morgan Stanley.
Okay.
We upgraded Morgan Stanley today. We're now buyers of the stock. As you know, I was on your show for 5 years, from 2012 to 2017. The stock tripled or quadrupled at a time when the market didn't quite double. It was the right call that we got off of Morgan Stanley because the restructuring story we thought ran its course. But now we think they have some additional restructuring left. In addition, better than expected growth than what we had forecasted before. And what you're seeing here at Morgan Stanley is 21 years after the merger of Morgan Stanley with Dean Witter, you're now seeing the full benefits of the brokerage, the wealth management part of the firm, fully playing out. You have the best ever pre-tax margin in its history, and we think it goes higher still. We love that half of the firm. And the other half of the firm, capital markets, they're executing better than almost anybody had expected. Really strong in equities. Ted Pick, head of that business now, broader trading business. He's getting the job done. So trading at 1.2 times tangible book, that's unheard of for a company where we expect their return on tangible equity to approach 15% in a couple of years. We are now buyers again, Scott, of Morgan Stanley.
Why isn't anybody else? I mean, why don't people want to own bank stocks?
Well, it's that
you just painted the most beautiful picture of a bank stock that I've heard in a long time. Well, why don't people want to own these stocks?
Because the macro strategists, 10,000-foot thinkers, have dominated the conversation. They have these themes. The proxies for growth are slowing. Therefore, who wants to own banks late cycle? That's the concern. That's why banks are weak. What we're saying is the cycle's not over based on what we're seeing and hearing from the banks themselves. It's certainly not peak earnings. And even if we're pricing in slower earnings growth, we think banks can pass the test because it's not so much about top-line revenue growth. It's about better efficiency, share buybacks, more resiliency. That's a theme that works for banks. And by the way, that's the opposite of before the financial crisis. If you're waiting for great top-line revenue growth from the banks, how did that turn out in 2006 and 2007? Not so well. This is the opposite of pre-crisis, when banks have slower but more sustainable earnings growth. That's what will sustain, the bank stocks over the next couple years. And, that's the story here, resiliency of the banks.
1 week. Morgan Stanley down 7, Goldman down 6, JPM down 5.5, Bank down 8.5, Citi down 7.5, XLF down 5.5, KBE down 8, KRE down 9.
You know what we hear from investors recently?
I don't even have to ask a question in that.
Well,
it makes its point.
Thanks for reading off my portfolio.
Right? The sentiment is negative. We hear that across the board. Well, that's as fundamental analysts. I'm not a chart reader. I'm looking at earnings growth now and over the next several years. Eventually, stock prices follow earnings growth. For the 3 largest banks, Citi, Bank of America, and JP Morgan, over 4 years, we expect 50% higher EPS. So if you're saying peak earnings, absolutely no way. That's not the case right now.
What about peak economy, peak growth?
Look, if we're pricing in a deceleration of
loan growth is already not spectacular in what's been the hottest economy in nearly a decade.
Well, look, you do have non-bank competitors. They've inched in. we much prefer banks not playing in that game, the higher risk loans like you saw for the last 3 or 4 decades. So if you have a little bit less revenue growth, that's fantastic. We should be applauding that banks aren't playing in that game and cutting costs a lot more. Compensation's going. It's not rising like it once did, for sure, for anyone across the board. The role of technology. In fact, we expect efficiency in the banking industry in 5 years to be the best it's ever been for U.S. banks.